questions. Après sa déclaration,
Governor Carolyn Rogers will be happy to take your questions. So I'll turn it over to Governor Macklem for his opening remarks. À vous la parole.
Good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to elaborate on today's monetary policy report and our policy announcement. Today, we lowered our policy rate by a further 25 basis points to 4.5%. This decision reflects three considerations. First, monetary policy is working to ease broad price pressures. Second, with the economy in excess supply and slack in the labor market, the economy has more room to grow without creating inflationary pressures. And third, as inflation gets closer to the 2% target, the risk that inflation comes in higher than expected has to be increasingly balanced against the risk that the economy and inflation could be weaker than expected. Aujourd'hui, on a abaissé.
today, we lowered our policy interest rate a further 25 basis points to 4.5%. This decision reflects three key considerations. First, monetary policy is working to ease broad price pressures. Second, with the economy in excess supply and slack in the labor market, the economy has more room to grow without creating inflationary pressures. And third, as inflation gets closer to the 2% target, the risk that inflation comes in higher than expected has to be increasingly balanced against the risk that the economy and inflation could be weaker than expected.
Looking ahead, we expect inflation to moderate further, though progress over the next year will likely be uneven. This forecast reflects the opposing forces affecting inflation. The overall weakness in the economy is pulling inflation down. At the same time, price pressures in shelter and other services are holding inflation up. We are increasingly confident that the ingredients to bring inflation back to target are in place. But the push-pull of these opposing forces means the decline in inflation will likely be gradual, and there could be setbacks along the way. If inflation continues to ease broadly in line with our forecast, it is reasonable to expect further cuts in our policy rate. The timing will depend on how we see these opposing forces playing out. In other words, we will be taking our monetary policy decisions one at a time. Let me highlight some of the economic dynamics covered in today's monetary policy report. Economic growth in Canada has picked up, but remains weak relative to population growth. Household spending has been soft. Pent-up demand for things like new cars and travel is fading. And many families are setting aside more of their income for debt payments, leaving less money for discretionary spending. In the labor market, employment has continued to grow more slowly than the labor force. Job seekers are now taking longer to find work, and the unemployment rate has risen to 6.4%. The job vacancy rate has come down significantly, and reports of labor shortages are now below normal. Overall, indicators suggest some slack in the labor market. Wage growth is also showing signs of moderating, although it remains elevated. Looking ahead, economic growth is expected to increase in the second half of 2024 and through 2025. This reflects stronger exports and a recovery in household spending as borrowing costs ease. Business investment is also expected to strengthen as demand picks up, and residential investment is forecast to grow robustly. Overall, with the economy strengthening, excess supply will be absorbed next year and into 2026. CPI inflation moderated to 2.7% in June after increasing in May, and broad inflationary pressures continue to ease. The bank's preferred measures of core inflation have now been below 3% for several months and the breadth of price increases across components of the CPI is near its historical average. Corporate pricing behavior has largely normalized, and near-term inflation expectations have come down, although they're still above normal. However, shelter price inflation remains high. Inflationary pressures are also evident in services that are closely affected by wages, such as restaurants and personal care. The bank's preferred measures of core inflation are expected to slow to about 2.5% in the second half of 2024 and ease further in 2025. CPI inflation is forecast to come down below core this fall and settle sustainably around the 2% target next year. But it's unlikely to proceed in a straight line. As always, there are risks around our inflation outlook. Globally, geopolitical uncertainty is high. Here in Canada, the biggest downside risk is that household spending could be weaker than expected. On the upside, inflation in shelter and other services could prove more persistent. So let me conclude. Comme les pressions généralisées sur les prix.
With broad price pressures continuing to ease and inflation expected to move closer to the 2% target, Governor Council decided to reduce the policy interest rate by a further 25 basis points. In recent months, we have continued to make progress bringing inflation down. But now, with the target in sight and more excess supply in the economy, the downside risks are taking on increased weight in our monetary policy deliberations. We need growth to pick up so that inflation does not fall too much.
Governing Council decided to reduce the policy interest rate by a further 25 basis points. In recent months, we have continued to make progress bringing inflation down. With the target in sight and more excess supply in the economy, the downside risks are taking on increased weight in our monetary policy deliberations. We need growth to pick up so inflation does not fall too much, even as we work to get inflation down to the 2% target. We are carefully assessing the downward pull on inflation from ongoing excess supply and the pressures from shelter and other services that are holding inflation up. Monetary policy decisions will be guided by incoming information and our assessment of their implications for the inflation outlook. The bank remains resolute in its commitment to restoring price stability for Canadians. And with that, the Senior Deputy Governor and I would be very pleased to take your questions.
Okay, thank you, Governor. I'll just quickly go over the ground rules. I've got a pretty long list of reporters here in Ottawa in the room. I've got a handful on the phone as well. I'll start here in the room, and as usual, I'm going to have to ask you to please limit yourself to one question to maximize the chances of getting to every outlet. If I forget to do so, please state your name and affiliation. Avant de poser une question, veuillez vous identifier.
Please give your name and your media affiliation before asking a question. And of course, you are free to ask any of your questions in the official language of your choice.
From Mark Rendell of the Globe and Mail.
Thank you for taking the question. In your opening statement, you spoke about increasingly having to balance upside and downside risks. And I'm wondering, does this emphasis on balance that you're focusing on here imply that interest rates need to fall relatively quickly to avoid a recession? And how much of a downside risk are mortgage renewals that we're expected to see over the next couple of years?
Well, Mark, I'd stress two elements here in terms of this emphasis on the need to put more weight on balancing the risks. The first is the symmetric nature of our inflation targeting framework. When inflation was high, when it was well above the 1 to 3% band, we were naturally more concerned about the upside risks than the downside risks. We were a long way above our target. We were above the band. We really didn't want surprises that pushed us further away. If we got a surprise that pushed us closer to the target, well, that wouldn't be so bad, would it? we're now back in the band. We've been in the band for a number of months, and our own forecast has inflation continuing to get closer to the 2% target. So, in that situation, we need to be more symmetric once again in our treatment of the risks. Remember, in general, our inflation targeting framework is symmetric. So, we are equally concerned about being below target as we are about being above target. So, when we say with the target in sight, it's more important to balance these upside and downside risks. That's what we mean. The second element is, where the economy is right now. The economy is in excess supply. There's slack in the labor market, and that is, acting to pull inflation down. Our assessment is there's enough excess supply in the economy. The ingredients increasingly are in place to bring inflation back to the 2% target. We don't need more excess supply. We need growth to start picking up. We need job creation to start picking up, to absorb the excess supply in the economy and get inflation sustainably back to target. And that need for growth to pick up was something that weighed on our decision was part of our decision to cut the policy interest rate today.
Okay, next we will go to Pramit Mukherjee from Thomson Reuters, please.
Hi, Governor. So from now till the end of the year, there are 3 more monetary policy meetings scheduled. Do you think we can end the year with 3.75%, that is 3 more cuts, or do you think a pause will be more prudent sometime?
Okay, so you want to know where interest rates are going. Okay, let's spend 30 seconds on today's cut before I get to that question. So, we lowered today. Why did we lower today? Look, our indicators are suggesting that broad-based price pressures are easing, and we are increasingly confident that the ingredients are now in place to bring inflation back to the 2% target. This is the second cut. We cut in June, we cut again today. That's brought our policy rate from 5 down to 4.5. So now, looking ahead, if inflation continues to evolve broadly in line with our forecast, it is reasonable to expect further cuts in our policy rate. But we're not on a predetermined path. We're going to be taking it one decision at a time. So what's in our forecast? Well, our forecast has inflation declining gradually. It's probably not going to, that decline in inflation is probably not going to be a straight line back to the target. As I outlined, there are these 2 opposing forces. Excess supply in the economy, slack in the labor market, that's pulling inflation down. But we're seeing ongoing pressures in shelter price inflation. We're also seeing some price pressures in some other services. Those things are holding inflation up. The push-pull of these opposing forces means that decline in inflation is likely to be gradual, and there could be some setbacks along the way. So what we're going to be doing going forward is we're going to be carefully assessing these push-pull forces, and we're going to be taking our decisions one at a time. So as to put it in a sentence for you, it is reasonable to expect further cuts, but the timing is going to depend on incoming data and, importantly, what that data tells us about where inflation is headed.
Okay, we'll go to Randy Thantong-Knight from Bloomberg, please.
Hi, Governor. Quora has been as much as 5 basis points above the target rate again. You started overnight repo operations last week. Settlement balances are concentrated among Canada's 3 largest banks. What's going on in the overnight markets, and is it time to wind down QT?
Yeah, I can ask Carolyn to talk about our monetary policy operations.
Yeah, Thanks for the question, Randy. So there's, as you point out, there's a couple of different things going on in the overnight market. So we've been in with our regular market operations trying to smooth some of those things out. We talked about this at the last decision, I think. There was some pressure on overnight rates as a result of something called the basis trade, cash futures basis trade. We still see some of that activity in the market. What's new since then is Canada has moved to a T+1 settlement on securities, so a tighter settlement on securities. That's increased the demand for overnight money too. And as you point out, there's still what we think to be enough settlement balances in the system, but they're not necessarily in the spots they need to be on any given overnight cycle. So all of those things are putting some pressure on CORA, on the overnight rate for money. And so we're doing what we normally do in those situations. We're coming in with market operations to smooth that out. We don't think we're at a normalized state on our balance sheet yet. We think there's more room to go on settlement balances, but as we do get closer to what we think is a normal state, we'll be paying very, very close attention. We're talking to market participants on a regular basis, so we'll be keeping an eye on this.
And we'll be keeping you updated.
Yep.
Okay, Paul Vieira from the Wall Street Journal, please.
Given the sort of the concerns about downside risks in the economy and the need to stimulate growth, was there any consideration given to a 50 basis point rate cut?
Look, in terms of the decision, there was a clear consensus to cut by 25 basis points. There was clear consensus that the expected path of the policy rate is lower, but we're not on a predetermined path. We're going to take it one meeting at a time. So that was really the main outcome of the meeting. I think the other element was a broad agreement that inflation's going to come down. It's going to keep coming down, but progress could well be uneven. There could be some setbacks along the way. These opposing, we got to watch these opposing forces, and we should try and explain that and be clear that we're going to be taking it one meeting at a time.
Next question is from Kevin Carmichael of The Logic, please.
Governor, stagflation is thrown around quite liberally over the last couple of years, but I wonder, looking at this forecast, given the stickiness that you're seeing around service inflation, for example, in wages, and some weakness around growth, if it's not something that's become more of a risk now?
I don't know. I don't think 2.7% inflation is what anybody would call stagflation. I mean, look, we're within our inflation band of 1 to 3%. The message is, we've made a lot of progress. We're getting back into a much more normal zone. If you look at those 4 indicators that we've been highlighting for a while, they've largely moved from red to green. Wages still a bit sticky, so that one's not there yet. Inflation, headline inflation, core inflation have been within the 1 to 3 band now for several months. We expect to see them continue to ease gradually. So, that isn't, to me, that doesn't describe the situation we're in. We're in much more of a situation where we need growth to pick up because there's considerable excess supply, even as we continue to get inflation coming down towards the 2% target.
Greg Quinn from Market News, please.
Good morning. I wondered, in short, how restrictive is monetary policy right now? In a longer sense, inflation has slowed and some measures of expectations in your own surveys have have come down quite a bit in recent months. So is there any argument there that perhaps these rate cuts are only kind of treading water when it comes to the real cost of borrowing?
Look, our assessment is monetary policy is still restrictive. We still need, there's still, look, inflation's still 2.7%, core inflation's about the same. We still need to get inflation down. And so, yeah, we still need monetary policy to be somewhat restrictive. We don't need it to be as restrictive as it's been. We've made a lot of progress. We're confident that the ingredients are in place to get us back to target. It doesn't need to be as restrictive as it's been, and that's why we've cut our policy rate at the last two meetings.
Okay, welcome to this side of the room now. And next I have Najouda Amalise from the Canadian Press.
Hi, Governor. Given you just cut twice in a row, I'm wondering if it's reasonable for Canadians to expect you to continue cutting at every rate decision so long as inflation eases.
Look, I think I've been pretty clear. The expected direction of our policy rate is lower, but we're not on a predetermined path. There are, as I've outlined, there are these opposing forces, and we need to see how they play out. We're going to be, looking at incoming information. In particular, what we want to get out of that information is what is it telling us about where inflation is headed? What is it telling us about whether the economy is starting or going to be picking up? Those are the things that we're going to be looking for. We want to balance the risks on both sides. We are determined to get inflation back to 2%, but we also don't want to weaken the economy too much and have inflation go below our 2% target. So those are all the things we're going to be weighing going forward. We're going to take it one meeting at a time.
My next question is from Mackenzie Gray from Global, please.
Hi there. In the NPR Day, there's a lot of talk about immigration and the really big boom that we've seen so far, in particular Chart 11 talking about GDP per capita growth. Is it your belief, Governor, that the Canadian economy in 2023 would have been in a recession without the increase we've seen in population growth? And for the Deputy Governor, too, can you just talk about, in terms of the housing front, how you see that immigration boom really playing out over the medium term for the housing market?
Well, why don't you start off on the housing, immigration, and effects on inflation?
Sure. So I'll take a bit broader step back on housing. So it's absolutely the case that housing's sensitive, housing activity, whether it's construction or sales, is sensitive to interest rates, sensitive to lots of other variables too, zoning, permitting, the availability of labor, and it's absolutely sensitive to population growth. And we've had record population growth in Canada against what was already a constrained supply. So we've had a long-standing housing imbalance in Canada. I'm from Western Canada. We've been feeling it for years. It's moved to other big cities in Canada in recent years, and during the pandemic, it moved even to smaller cities. So it was there before interest rates went into sort of emergency low levels. It's still with us now that interest rates have gone up. So it's a structural imbalance, and it would be a mistake to think that we're going to fix that miraculously with a single solution of interest rate changes. So shelter inflation has some similarities. It's absolutely the case that our interest rate decisions have a direct and near immediate effect on mortgage interest costs, which is a big part of shelter inflation. But there's other things inside shelter inflation. Rent, for example, rent continues to increase. Other housing costs, insurance, taxes, maintenance, those are all rising too. We can look past mortgage insurance to a certain degree, but those other costs are real costs for Canadians, so we can't look past them. So, I mean, the bottom line on housing is we are going to lower interest rates if the economy continues to go in the direction that we expect. That'll have some effect. That'll help on housing, but it isn't the magic solution. It would be a mistake to pin all of our hopes on our housing imbalance on interest rates. Canadians need a more fulsome, more coordinated policy response than that.
I mean, coming back to this issue of whether, should you look at per capita GDP or total GDP? I mean, from a monetary policy perspective, we got to look at both because they're both affecting the economy. And we've been, the whole reason to put in charts like Chart 11 that show you both per capita GDP and population and split it out is to sort of help explain that. If you think about what's happening for every individual household, well, that's like per capita consumption. So, I mean, what you see is that households have actually been cutting back on spending. That's been quite weak, but with high rates of immigration, more non-permanent residents coming into the country, there are more households. So, that's boosting GDP. I mean, you think of it from a perspective of a business, whether demand is up because individual households are consuming more or because there's more households, it doesn't make too much difference. It's still demand. And in the housing market, it's still demand for rent. It's still demand for houses. So you can't ignore, you got to think about both of these things. It is helpful to break it down because it helps understand how people are feeling, how people are behaving. When you look at consumer surveys, you look at surveys of consumer sentiment, you see they're pretty soft. And I think that reflects that on an individual basis, households are feeling the pinch. They are cutting back discretionary spending. We can see that in their behavior. For the economy as a whole, though, there are more households, and we have to factor that in. So, I mean, these are both things that we have to take into account. They're both things that are affecting the economy. They're both affecting inflation, and they're both ultimately affecting the path for interest rates that are going to get us inflation back to 2%.
Okay, our next question is from Jordan Gowling from Post Media.
Hi, good morning. Unemployment ticked up last month, and your own Business Outlook survey looks like hiring appetite is going to soften quite a bit over the next year. How worried are you about this, and how much of an impact will it have on your future rate decisions if it worsens?
Well, I gave a whole speech on the dynamics in the employment market 2 or 3 weeks ago in Winnipeg. But so let me give you the short version. We've seen a big adjustment in the labor market, and through that adjustment, we have not seen a lot of big job losses. What we have seen is that employment is growing more slowly than the labor force is growing. So, put that. What does that mean? Well, businesses in general, on net, they are hiring, but they're not hiring or creating as many jobs as there are new people entering the labor market. So, and you see that in a few dimensions. What it basically means is if you're entering the job market, it's taking longer to find a job, and you can see that in the job finding rate is going down, and the unemployment rate has been ticking up, reaching 6.4%. If you look at how that's affecting workers, it's not affecting all workers in the same way. It's particularly affecting new entrants into the labor market. So it's the younger worker who's finished schools, graduated, and is entering the labor market looking for their first job. It's taking longer to find that first job. It's the new immigrant, the new non-permanent resident that's entering the country looking for a first job. It's taking longer for them to find their first job. So their unemployment rates have moved up just proportionally more than other parts of the labor force, what we often call prime age workers. What that's telling us is there is some slack in the labor market. And that is, something that we certainly factored into our monetary policy decision. Going forward, I mean, we think there's enough slack in the labor market. There's enough slack in the economy overall to bring inflation down. We are seeing the effects of slack pulling inflation down. We're seeing broad inflationary pressures ease. Going forward, our own forecast has GDP growth picking up. And with that, could be a bit of a lag, but with that, you would expect job growth to pick up. That's something we think needs to happen, and that is something that factored into our decision to cut our policy rate a second time.
Okay, let's go to Alicia Sikirska from Yahoo Finance, please.
Thank you. Governor, despite inflation monitoring, Canadians are still feeling the pain of higher prices and cutting back on spending. How is the bank hoping that Canadians will think about this second consecutive cut and the potential of further cuts?
Well, I think, look, you've got two cuts now, 50 basis points, and even before we started cutting, the anticipation of cutting was starting to reduce 5-year mortgage rates. If you have a variable rate mortgage, you'll get some immediate relief. So, look, this isn't a huge change, but first of all, it does mean that Canadians. It means that the cost of carrying debt is going down. Canadians will have more income left for other things. And if we continue to make progress, inflation continues to come down broadly in line with our forecast, it is reasonable to expect some further cuts going forward. As I said, we're not in a predetermined path. We're taking it one at a time. But I think the broad Canadians are getting some relief there. And I mean, if you look at household sentiment, I think what you're seeing is that it certainly weakened. It's been relatively stable recently. And, hopefully this starts to improve sentiment. As I said, we do want to see growth pick up. We do want to see job growth strengthen. We think there's some good reasons why that's going to happen. This interest rate cut should help.
We've seen Canadians' expectations on inflation starting to come down too. They were stuck pretty high for a long time. That's encouraging to us. It means Canadians are feeling that monetary policy has been working, but it's been tough. And even when inflation comes back to target, price levels are higher, groceries are more expensive. Canadians are feeling that. So, do we feel good that we're able to, we see rates coming down, helping take that pressure off Canadians for sure, but we absolutely need to get inflation all the way back to target too.
Okay, before we go to the phones, I have one last question here in the room, and it is from Annie Bergeron-Oliver of CTV, please.
Hi, I'm just wondering if you can tell me a bit about how much do future rate decisions depend on how and what other central banks like the Fed decide to do when it comes to their own interest rates?
It very much depends on what's going on here in Canada. We have a flexible exchange rate. We have our own monetary policy in Canada. We are very focused on delivering what Canadians need. Obviously, what goes on in the United States in particular has an impact on Canada. In terms of the divergence in policy rates, I mean, our policy rate didn't go as high as the U.S. rate. We've obviously cut now twice. The U.S. has not cut. So that divergence is widening. Yes, there are limits to how far Canadian and U.S. rates diverge. We're still not close to that limit. And, with inflation showing more signs of easing in the United States, my sense is that, that divergence is not going to be particularly serious.
Okay, that's it for Ottawa. We're going to go to the reporters who have joined remotely now. I'm just going to remind you, please, to come off mute only to ask your question, then go back on mute as soon as you finish so everybody can hear the response. I'm going to start with Anna Pereira of the Toronto Star before going to BNN Bloomberg. Anna, please go ahead. Anna, are you still there? Okay, we'll cycle back. BNN Bloomberg, please. Yeah, this wasn't going to go smoothly, was it? All right, let's try Max Sato from Mace News, if you're there.
Thanks, Paul. Governor, I'm not particularly criticizing your policy here, but when central banks raise interest rates rapidly or maintain restrictive policy to bring inflation back to target, it tends to make the inequality between the high and the middle to low income earners worse. Is there any better specific way to coordinate among monetary, fiscal, and other policies to redistribute wealth and hopefully ease the pain of lower income earners?
Well, it's a big, broad question. First thing I'd highlight is inflation disproportionately affects poorer people. I mean, look at what happened when inflation went up. Where is it? It's been particularly in food. It's been particularly in rent. These are necessities. You can't cut back on necessities. Obviously, people with lower incomes, necessities are a bigger part of their basket. You can't cut back on them. They are much more affected. They obviously have less smaller savings buffers. So, the best thing monetary policy can do for all Canadians is to get inflation down. And, that's particularly important for lower income Canadians. More broadly, yes, you're right. Monetary policy, it's a broad macro policy. We don't have the ability to target individual groups, individual sectors with different interest rates or different rates of inflation, different growth. It's a broad macro tool. Fiscal policy really is the tool that has the ability to target different groups, and fiscal policy is appropriately the responsibility of our elected governments, and I'm going to leave it to their best judgment on how to conduct fiscal policy.
Okay, I have it on very good authority that Anna Pereira is back on the line. So Anna, please come off mute and go ahead and ask your question.
I'm so sorry, I had technical difficulties. So there was a large rise in unemployment from pandemic trough to peak, and it's resembling recessionary periods. And as you said, Governor Macklem, unemployment is not impacting Canadians evenly. So there are people who are very much living under recessionary conditions right now. They're experiencing a recession. Given all of that, do you wish you had cut rates sooner?
Look, we are comfortable with where rates are. We still need monetary policy to be somewhat restrictive. As I've indicated, we are increasingly confident that the ingredients are in place to bring inflation back to target. But one of the reasons for that is that monetary policy is somewhat restrictive. If monetary policy was not restrictive, I don't think we would be getting inflation back to target. We need some restrictiveness. It doesn't need to be as restrictive. That's why we lowered rates. And going forward, if things evolve broadly in line with our forecast, it can be less restrictive. We can, in other words, it's reasonable to expect further cuts in our policy interest rate. But no, we're comfortable with where we are. We've cut our policy rate now at the last two meetings, and yeah, we think that's appropriate.
Okay, I'm just going to remind people on the line, come off mute only to ask your question, and then go back on mute as soon as you're finished. And I'm going to try again with BNN Bloomberg.
Okay, Governor Macklem and Senior Deputy Governor Rogers, thank you for taking my question. The bank says it wants economic growth to pick up. It said that several times today. It also identifies debt servicing costs by households as a major headwind to economic growth. My question is, does the bank have a forecast or a horizon in which it believes that household debt servicing costs may become less of a headwind to economic growth in Canada?
Yeah, I mean, we took a pretty deep dive on debt service costs month or two ago when we walked through our financial stability report. We do see some risk to that. It's outlined in the monetary policy report. There is a risk that the combination of mortgage renewals, an increasing portion of household costs going towards higher mortgage payments, higher debt service payments, having a dampening effect on household consumption. That could mean that we don't get some of the pickup that we expect. But we also know that as we've monitored this issue over the last 2 years, households have told us they've got some precautionary savings. They've been planning for these renewals. So it's something we're going to have to watch closely. It is a potential risk. It's one of the ones we highlight in the monetary policy report.
Okay, and our final question is from Rob McClister of Mortgage Logic News. Please come off mute and ask your question, Rob.
Good morning. One of the biggest inflation risks out there is fiscal spending. Other things equal, if deficit spending in the United States and Canada continues at the current inordinate pace, how significant of a risk does that create of interest rates maybe bottoming out sooner than expected or potentially even going back up in Canada over the next few years?
Well, we're not in the business of evaluating different, the implications of different policy choices by the U.S. or the Canadian governments. In terms of fiscal policy, what we do when we do our economic forecast is we take announced policy decisions by governments and we factor those in. So since our April report, when we did our April monetary policy reports, most of the provincial budgets were out. The federal wasn't. Since then, obviously, the federal government published their budget. So we now have all the provincial budgets, the federal government's budget. The plans that are built into that budget are reflected in our forecast for government spending. And what you can see is that, yes, government spending is, 2 to 3%, I think closer to 3% over through next year. So that's certainly contributing to growth. That's something that's built into our forecast. And as you can see, you've got the overall growth forecast, you've got the overall inflation forecast, and we've built in those plans. If governments change their plans, we'll put in the new plans, and that will. If it's a significant change, that could have implications for growth and inflation, and we'll take those into account going forward.
And with that, we've come to the end of today's press conference. So thanks to the Governor and Senior Deputy Governor. Thanks to all of you for joining us. Bon été tout le monde. Enjoy the rest of your summer.
Yeah, let me just join in wishing you all a good summer. And to our athletes in Paris, we wish them a great Olympics. We're so proud of you. Go for the gold. Thank you.